Hi everyone, welcome to the session. In this session, I'll be discussing about standard costing and variance analysis. Okay, so under this, I'll be discussing about different types of variances. So, like such as direct material variances, direct labor variances. Then we have variable production overhead variances. Then fixed production overheads and sales variances. Okay, so basically we have different types of variances that we need to calculate under standard costing and variance analysis. So we have uh, direct material variances. Under this, we have to calculate two types of variances, basically the price and the usage variances. Okay, and under direct labor, we have again two types of variances, basically rate and efficiency variances. Then we have variable production overheads. So under this also we have two types of variances, basically the expenditure variance and efficiency variance. Under fixed production overhead, also we have two types of variances, basically expenditure and volume variance. We have expenditure and volume variance, and also this volume variance can be subdivided into further two types of variances, basically the volume efficiency and volume capacity variances. And finally, we have sales variances. So under sales variances also we have to calculate two types of variances, basically price variance and volume variance. Okay, so these are the types of variances that we are going to look at under this standard costing and variance analysis. Okay, so let's first and foremost let's move on to the first one, the direct material variance. Okay, so now in order to understand this concept, let's go through a question. Okay, so I have selected one question. So through this question we'll try to understand the concept. Now product P has a standard direct material cost as follows. Okay, so this is the standard direct material cost. Okay, so basically this is our plan. This is our budget. What is our plan? We were planning to use material M 10 kg. uh, the cost per kg is 10 per dollar, $10 per kg. Okay, the per unit cost is $100. Okay, to produce one unit you need 10 kg, and the cost of 1 kg is $10. So therefore we have to incur $100 to produce one unit. So this is our plan. During a period 1000 units of P 1000 units of P were manufactured. So this is our actual production. Okay, using 11,700 kg of material M. So this is our actual consumption. Actually, we consume to produce 1000 units 11,700 kg, which cost $98,600. Okay, so actually we incurred 98,600. Okay. Now, basically, I told you the total direct material variance or direct material cost variance consists of two types of variances. What are those? Price and usage variances. So let's look at this. So direct material cost variance or the total variance consists of price variance and usage variance. The price variance means we compare the prices, the standard price and the actual price on the actual consumption. This is very important, okay? And the usage variance means the actual consumption we have to compare with our standard consumption or the planned consumption or planned usage, and that difference has to be multiplied by the standard cost of a material. So this is what we need to identify. So the direct material cost variance, basically, how do you calculate? Okay, so this direct material cost variance basically means you just compare the actual cost incurred, okay, actual cost incurred 98,600 on this 1000 unit with the budget. How much is the budget per unit? 100. Okay, so this is a total variance. Okay, so basically you compare the budget and the actual. Okay, to produce 1000 units, to produce 1000 units, you plan per unit $100. So therefore 100,000. So 1000 units should have cost, okay, 100,000. So basically 1000 units times $100. Okay, that should have cost, so 100,000. How much did it cost? It cost 98,600. So therefore we actually incurred a less amount than the plan. So therefore the variance is a favorable variance of 1,400. So this is our variance, the total variance. So we planned 100,000, but we incurred 98,600. Okay. Now, the total variance consists of two components. One is the price, and the other one is the usage. The direct material price variance, what does it mean? Now, here, direct material price variance, we need to calculate on the actual usage of material. Okay, just compare how much should I have incurred to produce actual uh, material requirement. So actually you consume 11,700 kg. Okay, for that you incurred 98,600. Provided if you had used the standard rate, so standard or the planned cost was 10 per kg. How much you should have incurred on this 11,700? So on 11,700 kg of material M should have cost 11,700 times 10. This was our plan, the standard cost. So We should have incurred 117,000 on the actual material consumed. However, we incurred only 98,600. Okay, so therefore we have a favorable variance of 18,400. Is that clear? So we have a favorable variance of 18,400. Now let's move on to the usage variance. Now here the usage variance means we have to compare the standard consumption, standard usage, and the actual usage times the standard rate. So the standard usage, how much? We need 10 kg per unit. We produced 1000. So therefore, we should have used how much? 10,000, right? 10,000 kg. So this should be 10,000 kg. So 1000 units should have used 10,000 kg to produce 1000 units because we need per unit we need 10 kg. So how much did we use? We used 11,700 kg to produce 1000. So 11,700 kg. So therefore we had a usage variance of 1,700 times our planned cost was 10. So therefore we will have a usage variance, direct material usage variance of 17,000 adverse. Why? We were planning to use to produce 1000 units 10,000 kg, whereas we used 11,700 more materials being used to produce 1000 units. So therefore, it's an adverse variance. Now, when you compare this 18,400 and favorable variance and 17,000 adverse variance, so favorable against adverse, you can see the difference. 18,400 minus 17,000 will be the total variance or the cost variance of 1,400. It's a favorable variance. So this is the basically this is how you calculate the direct material price and the usage variance. Okay, so therefore this direct material cost variance consists of direct material price variance and usage variance.